Here's the million-dollar question that's been buzzing through the ETF community. Is QDVO, the new tactical covered call fund that launched just over a year ago, actually better than the established giants QQQI and JEPQ? And here's what makes this so interesting. QDVO has delivered a stunning 20.75% year-to-date return as of October 2025, crushing both QQQI at 15.3% and JEPQ at 12.91%. But before you rush to hit that buy button, there's a twist to this story that most investors completely miss. By the end of this video, you'll know exactly which of these three funds matches your specific investing goals, because spoiler alert, the answer isn't the same for everyone. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. Let's set the stage for this three-way battle. In one corner, we have QDVO, the Amplify CWP Growth and Income ETF, launched in August 2024 with $375 million in assets. It's the tactical newcomer that writes covered calls on only 30 to 50% of its portfolio, preserving upside potential while still generating income. In the second corner, there's QQQI, the NEOS Nasdaq 100 High Income ETF, with $5.94 billion in assets since its January 2024 launch. This is your income maximizer, delivering a massive 13.36% yield through full portfolio coverage using Nasdaq 100 index options. And in the third corner, the heavyweight champion JEPQ, JP Morgan's Nasdaq Equity Premium Income ETF, commanding $31.36 billion in assets, with over 3 years of track record. It's the balanced approach that combines active equity selection with systematic options overlay. The fundamental difference here is philosophy. Tactical flexibility versus systematic income generation versus institutional balance. Now let's talk about what really matters. Performance. QDVO's 20.75% year-to-date return isn't just impressive, it's dominating. But here's where the story gets interesting. When we look at price appreciation alone, excluding distributions, QDVO shows 16.73% gains since inception, beating JEPQ's 16.48% and absolutely crushing QQQI's 8.66%. Why does QQQI lag so badly in price appreciation? Because it's returning almost all its gains to shareholders through that massive 13.36% yield, instead of retaining capital for NAV growth. This reveals the fundamental trade-off in covered call strategies. Then came the April 2025 correction, and this is where QDVO really proved its worth. While markets tumbled, QDVO experienced a maximum drawdown of negative 17.75%, outperforming both QQQI at negative 20% and JEPQ at negative 20.07%. What saved QDVO? Two things. Its superior sector diversification with only 41% in technology versus 54% for the others, and its tactical flexibility to adjust options coverage during volatile periods. All three funds have since recovered to zero current drawdown, but that April test revealed which strategy handles stress better. Let's shift gears to the income battle, because this is where things get really interesting. QQQI is the undisputed income champion, paying out 13.36 to 13.5% annually, which translates to roughly $7.41 per share in annual distributions. That's about 64 cents every single month hitting your account. JEPQ sits in the middle ground with 10.14% yield, paying approximately 45 to 62 cents monthly, while QDVO generates 9.08% yield, with monthly payments ranging from 19 to 29 cents. Now here's the critical detail most investors overlook: the 30-day SEC yield, which measures income from actual stock dividends after expenses, excluding option premiums. JEPQ's SEC yield sits at 9.45%, revealing substantial underlying dividend income from quality dividend-paying stocks. But QDVO's SEC yield is just 0.24%, and QQQI's is an even lower 0.07%. What does this mean? Nearly all of QDVO and QQQI's distributions come from option premiums, not stock dividends. This makes their income more volatile and dependent on options market conditions, while JEPQ has a more stable dividend foundation supporting its distributions. Now, here's the tax efficiency twist that could save you thousands of dollars annually. QQQI uses Section 1256 contracts, which are index options that receive favorable 60% long-term and 40% short-term capital gains treatment regardless of how long you hold them. Even better, QQQI's distributions are 100% return of capital, which doesn't create immediate taxable income. Instead, it reduces your cost basis and defers taxes until you sell. QDVO offers similar tax advantages with 96% of its distributions classified as return of capital as of September 2025. But JEPQ uses standard income distribution treatment without these special tax advantages. For investors in high tax brackets, this difference is huge. QQQI's Section 1256 treatment could save you 10 to 15% annually on tax liabilities compared to ordinary income rates. If you're holding these funds in a taxable account, this tax efficiency can meaningfully boost your after-tax returns over time. Let's go under the hood and understand how these three funds actually work, because the strategy differences explain everything we've seen so far. QDVO employs the most flexible approach, writing covered calls on only 30 to 50% of its individual stock holdings. Capital Wealth Planning, the fund's manager, actively decides when to write calls based on whether implied volatility is attractive enough to justify capping upside. They focus on out-of-the-money calls with 1-month duration, targeting 4 to 6% annualized option income while preserving most upside potential. This tactical flexibility is why QDVO captured more of the 2024 to 2025 technology rally. QQQI takes the opposite approach, systematic full portfolio coverage by selling NASDAQ 100 index call options. This generates maximum premium income but caps all upside above the strike price. When markets rally strongly, QQQI underperforms because all gains above those strike prices are forfeited. The trade-off is predictable, consistent income. JEPQ sits in the middle with its hybrid model, combining active equity selection based on JP Morgan's fundamental research with systematic equity-linked notes overlay. The team actively manages which stocks to own, then overlays call options through ELNs to generate income. The 168% turnover rate reflects this active trading to optimize both equity positions and options timing. Now here's where 2025 market conditions created a perfect storm for QDVO. During the low volatility environment of mid-2025, when the VYX dropped below 19, option premiums compressed significantly. QQQI and JEPQ continued writing calls systematically regardless of how attractive those premiums were, while QDVO could simply stand aside and preserve full upside participation. This flexibility explains QDVO's outperformance since the April low, even as the other two funds lagged during the subsequent low volatility rally. Let's talk portfolio composition, because understanding what you actually own matters. All three funds are dominated by the Magnificent Seven technology stocks, but with meaningful differences in concentration. QDVO shows the highest top 10 concentration at 63.27%, with Nvidia leading at 10.67%, Apple at 9.66%, and Microsoft at 8.83%. QQQI's top 10 represents 53.41% with similar leadership. Nvidia at 9.88%, Apple at 8.46%, Microsoft at 8.29%. JEPQ shows the broadest diversification with top 10 concentration of just 46.27% and slightly lower weightings in each of the giants. But here's QDVO's secret weapon: superior sector diversification. While QQQI and JEPQ both have 54% technology exposure, QDVO allocates only 41% to tech. The difference shows up in QDVO's meaningful positions in financials at 6%, industrials at 4.83%, and consumer staples at 5.59%. This broader sector mix directly contributed to QDVO's better drawdown management during the April correction. When tech sold off, QDVO had other sectors providing ballast. There's also a holdings count difference worth noting. QDVO maintains just 25 actual equity positions out of 60 total holdings, with the rest in cash and derivatives. This concentrated approach enables tactical management but increases single-stock risk. QQQI and JEPQ each hold 107 positions, providing broader diversification across the NASDAQ 100 universe. Now let's address the elephant in the room: Costs and liquidity. QDVO's $375 million in assets makes it the smallest fund by far, with average daily volume of just 333,000 shares. For larger investors looking to build positions exceeding $1 million, this creates legitimate liquidity concerns. JEPQ dominates with $31.36 billion in assets and average daily volume exceeding 4.5 million shares. That's institutional-grade liquidity where you can move in and out without impacting price. QQQI sits comfortably in the middle with $5.94 billion and adequate liquidity for most investors. On expenses, JEPQ wins decisively at 0.35% annually, which is just $35 per 10,000 invested. QDVO charges 0.55% or $55 per 10,000, while QQQI is the most expensive at 0.68% or $68 per 10,000. Over 10 years, that 0.33% difference between JEPQ and QQQI translates to approximately $330 per 10,000 invested, not even accounting for compounding effects. However, you have to balance these cost differences against performance. QDVO's expense ratio is 33 basis points higher than JEPQ, but it's delivered 8 percentage points higher year-to-date returns. So who should choose what? Let's create 3 investor profiles. First, meet the growth seeker, someone who wants total returns combining both price appreciation and income, not just maximum current cash flow. If you expect technology sector strength to continue and you value tactical flexibility over systematic approaches, QDVO is your answer. The 96% return of capital distributions provide excellent tax efficiency for taxable accounts, and that superior drawdown management appeals to risk-aware investors. You'll need to tolerate the smaller asset base and limited 14-month track record, but the 27 to 28% annualized returns since inception make a compelling case. Second, the income maximizer. Typically retirees or income-dependent investors who need the highest possible monthly cash flow. If you're holding in taxable accounts and can benefit from Section 1256 tax treatment, QQQI delivers 13.36% yield with roughly 64 cents per share monthly. You'll accept lower price appreciation of 8.66% since inception because income certainty is your priority. The passive, systematic approach removes active manager risk, and $5.94 billion in assets provides adequate liquidity. Third, the balanced investor who wants both growth and income without extremes in either direction. JEPQ's 10.14% yield combined with 16.48% price appreciation since inception offers the best of both worlds. The 0.35% expense ratio is the lowest among the three, and $31 billion in assets with JP Morgan's institutional backing provides confidence and liquidity for larger positions. That 3+ year track record spanning the 2022 bear market, 2023 recovery, and 2024 to 2025 AI rally lets you evaluate performance across multiple market regimes, something the newer funds simply cannot provide yet. So here's the verdict on our original question. Is QDVO better than QQQI and JEPQ? The answer is, better for whom? All 3 funds deliver exactly what they promise, just with different objectives. QDVO wins on total return with that impressive 20.75% year-to-date and superior price appreciation, making it the clear choice for growth-focused investors who want income as a bonus. QQQI wins on maximum current income with 13.36% yield and unbeatable tax efficiency through Section 1256 treatment, perfect for income-focused retirees. JEPQ wins on balance, offering moderate income, respectable appreciation, lowest costs, and institutional-grade scale with the longest track record. The key insight is this: don't choose based on which fund has the best recent performance headline. Match the fund to your specific goals. If you need income now, QQQI's the answer. If you want growth with some income, go QDVO. If you want balance and institutional quality, choose JEPQ. One critical caveat about QDVO: that outstanding performance comes with only 14 months of history. Can it maintain this pace? We simply don't know yet. JEPQ's 3-year track record and QQQI's nearly 2-year history provide more confidence about consistency across market cycles. The data in this video is 100% accurate as of October 28, 2025, verified against official sources from Amplify, NEOS, and JP Morgan. If you found this comparison helpful, smash that like button and subscribe for more ETF analysis. Drop a comment telling me which fund matches your goals and why. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.